there, Maggie Richter from RPM Mortgage, giving you a brief video about what is the federal prime rate and how is it related to mortgage rates. Generally, we've been hearing a lot about the feds raising prime. They've raised it twice this year already and have talked about doing at least 2 more raises this year. And then we think, well, if they go up 0.25%, do mortgage rates go up 0.25%? And the answer is no. The federal prime rate is more the rate that banks borrow money from the Fed. So every day banks have a certain amount of reserves that they need to meet. So as people withdraw funds, they're not necessarily getting your loan or auto loan that they've lended out back that day. So they need to have a sufficient amount to meet certain regulations. So they might take those funds from the Fed. Generally, mortgage rates are tied to the 10-year bond or 10-year yield. So the Fed rate and the 10-year Treasury may not actually even be correlated at all. Sometimes how the Fed talks or acts by raising rates might affect how investors buy or sell on the 10-year Treasury, but generally over time there's been less correlation between them. Over the last 20 years, the difference between prime and the average 30-year mortgage interest rates varied between 0.5% and 5.25%. So generally we don't see a lot of correlation, but there is a relationship. If you want to learn more about mortgage rates or what a mortgage rate might look like for you, feel free to reach out and I'll talk to you soon. Thanks so much. Maggie Richter signing off.